Welcome back. If you're watching this, you've probably noticed that the 2026 housing market feels different. We finally moved past the pandemic panic and the rate hike heartbreak of 2024. Inventory is up about 9% nationwide, and for the first time since 2020, average monthly payments are actually starting to dip. But here's the catch. Because the market is stabilizing, first time home buyers are getting comfortable, and getting comfortable can be dangerous and people can make expensive mistakes. Today, we're going to break down the 10 biggest traps that are draining bank accounts this year. If you want to own a home without becoming house poor, then let's dive in. Mistake number one, the Fed wait and see trap. I see this all the time, waiting for the Fed to drop rates to rock bottom before buying. Let's just be honest, everybody. It's very, very, very unlikely that we're going to see 3%, 4%, even 5% Fed rates anytime soon. So we should just get used to the new normal of somewhere around 6.2. I think as I'm recording this, it's about 6.5. Those are just going to be the rates. So in 2026, many buyers are sitting around on the sidelines waiting for the magic 4% or 5% rate. It's just not going to happen anytime soon. And here's the problem why. The Fed is just one driver of the Fed rate. You have the 10-year Treasury yield and local inventory to worry about as well. By the time rates drop another 0.5%, home prices, which have been growing at about 2 to 3% a year, will go up. So any savings you're hoping to make on a rate drop, you've probably lost in home appreciation. The fix, buy houses and not the rate. If the numbers work for your budget at 6.3%, buy it. You can refinance later if the rates go down, but you can't rebuy your home at these prices. Let me repeat that. Buy now, refinance later if the rates go down. The housing prices aren't going to go down in a year, but the finance rates might. All right. Mistake number two, confusing pre-qualification with pre-approval. Anybody that's watched my videos hears me harp about this a lot. The difference between a pre-qualification letter and a pre-approval. Getting a soft letter online and starting to hunt for a house is fine, but the reality is sellers are becoming more selective. When you get a letter online after filling out a single page, that's a pre-qualification. They haven't really vetted you. So what you need to do is you need to fill out a loan application. You need to give them the ability to check your credit. You need to provide proof of your income. It doesn't have to be W-2 income. It could be 1099 income. And there's lots of different programs out there to get pre-approved. But they're going to look at your tax returns and they're going to look at your personal financial data. Filling out a letter online where you didn't have to provide any of that is not a pre-approval. That is merely a pre-qualification. So if you're serious about buying, get a verified pre-approval letter and then provide it to your agent, and you now are ready to actually shop, and you are a motivated buyer who will prove to a motivated seller that you are delivering the gold standard, that pre-approval letter. All right, number three mistake, ignoring the hidden $21,000. So most people only budget for the principal and interest. They don't budget for tax and insurance. Recent data shows that the average homeowner spends over $21,000 a year on hidden costs. So hidden costs could be HOA fees. It could be insurance. It could be the property taxes, things that you're not thinking of when you're just looking at the principal and interest when you're shopping for a house. Even Zillow will show you in a breakdown what's called the PITI, the principal, interest, tax, and insurance. They often will also publish HOA fees if you're buying in an HOA. So use now there is one other thing, and that is there are closing costs. So you should budget about 1% for your annual maintenance on your house, and you should budget 1% for closing costs when you're buying the house. All right, mistake number 4, the new car kiss of death. Oh my gosh, have I seen this more than once? Don't buy any new furniture, a new vehicle, a new boat, a new anything that's going to hit your credit during the escrow process. You will kill your deal. Let me repeat that. If you're a new buyer and you get excited because you got into contract and you happen to have a boat dock that doesn't have a boat on it, don't go out and buy the boat while you're still in escrow. Wait until you've closed escrow to go buy that boat. If you're buying a house and it's your first house and you don't have any furniture, don't go out and buy furniture before you close escrow. Then go out and buy furniture after you close escrow. Don't go buy a new car for that great 2-car garage you just got into escrow on, because you will kill the deal. The bank will stop the process and you will not be owning that house. So, this is a classic. Lenders are under strict scrutiny. They track every payment you make that attaches to your credit score. So do not mess with your what's called your DTI, your debt to income ratio. So do not, and talk to your lender about the debt to income ratio. I think it's 32 or 36% of your income can be debt. Anything above that, and you're going to kill your ability to finance this deal. All right. So talk to your lenders. They'll explain it in much more detail than I just did. But just know that it's a kiss of death if you go out and buy that boat, furniture, car while you're in escrow. It's not even good to buy it right before you think you're going to get into escrow. Just freeze everything while you're in escrow. Stick with the status quo. And if you've been pre-approved, don't mess with that. All right, number 5, skipping the inspection on newer homes. Now, I understand people like to inspect older homes, but believe it or not, newer builds are seeing a surge of issues. So don't skip inspections just because the house is 2 or 3 or 4 years old. Make sure you do all the inspections that you would normally do. Pretend the house is 50 years old. That way, you will know if you're buying a house that has foundation flaws, poor HVAC, roofing shortcuts. I will tell you from personal experience, I bought a new house once and was living in it, and I was having a problem where water came dripping through the ceiling into our kitchen. We had a waterfall coming through one of our recessed lighting. Come to find out, they hadn't even put glue on the pipes, and it took us about 6 months of living there before the pipe just opened up and the water came flowing through from up in the attic. Make sure your house is as fit as possible through the inspections before you buy it. You will thank me later. And you can often use those reports and what they find as a negotiation tool to lower the price. So if you have a really good real estate agent, they're going to advise you on all these things. So don't worry about it. But just know that doing those inspections is worth the $600, $800, $1,200, especially when you come and find a $15,000 issue that you can negotiate later. So spend the money. All right. Oh, and oftentimes, if those inspections are already provided to you, call the inspector, quiz him, ask him questions. You have a right to do that. All right. All right. So, mistake number 6, underestimating appraisal gaps. Oh, gosh. Okay. Offering over asking is great, except if the appraisal doesn't come in to the price that you've gone into contract for. So, an appraisal gap is basically you've gotten into contract, say, for $600,000 on a house, and the appraisal comes in at $575,000. You've got yourself a $25,000 appraisal gap. Now, depending on if you have an appraisal contingency in place, you can do one of three things. You can pay that difference yourself. You can ask the seller to pay that difference. You can negotiate between you two, or, and there's a fourth, if you can't come to terms and you don't want to pay it and the seller doesn't want to pay it, you can cancel the contract, assuming that you have the appraisal contingency in place. And I'm speaking from California. I know every state, I think, has some form of an appraisal contingency, but just know that if there's a gap in the difference between the price that you're offering to pay for a house and the price that it actually was appraised, you have to somehow resolve that between you, the bank, and the seller. Um, if it comes in over what you're offering for the house, hooray, let sleeping dogs lie. You just made some instant equity in the house. All right. So don't underestimate appraisal gaps and don't overprice a home just to win it, especially if you don't think it's going to appraise at the value. So keep an appraisal buffer in your savings account just in case you might need it if the appraisal gap is significant. It might only be $5,000, but still that's $5,000 you might have to come up with out of your pocket that you wouldn't have had to. So just be careful. All right. Mistake number seven, shopping the rate is not a strategy. So choosing the lender with the lowest advertised teaser rate in a banner ad is not necessarily the best choice of action. I know we all get emails constantly advertising some great low rate. So there's more to a rate than you realize. So if you're not familiar with the difference between the rate and the APR, the advertised I forget, I forget what the term is now. I just can't think of it off the top of my head. But the rate you pay is different than the APR. The APR includes closing costs, fees, and points. So a low rate is useless if the lender can't close on time and they hit you with, say, $10,000 worth of junk fees just to close really quickly. So execution is the king. You need a lender that understands the difference between FHA and conventional, and USDA and VA if you're a service member. Thank you for your service. So compare your loan estimates, not just the rates. Compare the closing costs, compare the fees, compare the points that you might be paying on a loan. So make sure that you get all that clearly spelled out for you. And if you have a good agent, they can kind of help you walk through that. And often agents know great local lenders. So make sure that you hire a great agent who can help you find a great lender. All right, mistake number 8, school district blindness. Buying in a hot neighborhood without looking at long-term zoning changes. In 2026, many cities are rezoning to allow for more high-density housing. This is a state or a nationwide trend. Every state has some different rules, but basically, they want to compact housing into smaller and smaller spaces and create more and more housing. We call that housing density. So that quiet cul-de-sac that had a 4-story apartment complex behind it might have a 10-story complex behind it in 2 years. So make sure that you understand the general plan and the 2030 vision of your neighborhood and your city. Don't just shop the school district without actually shopping the zoning and understanding the zoning rules and how they might be changing in your neighborhood, and how that could affect your property rates long term. All right. Mistake number 9, forgetting the supplemental tax bill. And I can tell you from personal experience, I just got a call the other day from a client who I had warned that this bill was coming when we were in escrow. But in California, in the county that I was working in, it takes about 18 months for that supplemental tax bill to show up. And it's been about 18 months since they bought that house. So they forgot the conversation that I had. And all of a sudden, they got hit with a $20,000 supplemental tax bill. It was a nice, expensive house they were buying. But not realizing this bill is coming is a real sticker shock and a real hit to the bank account if you haven't budgeted for it, or you did budget, you forgot, and you spent it. So in California, We have supplemental taxes that come after about 18 months after you closed the house. And what the supplemental tax is, it's a one-time hit. But let's say your house was worth 200 or was on the tax rolls for $200,000. You've paid $600,000. Well, that supplemental bill is the $400,000 difference that's going to hit with the tax rate. So here in California, we have a tax rate of 1%. So that's a $4,000 hit plus any bonds and things like that. So if you'd forgotten about that and all of a sudden a $4,000 tax bill hits you, you're in a pretty big shock. So don't forget to budget for the supplemental taxes that are going to come after the close of escrow and probably 12 to 18 months after you've closed escrow on that house. It's going to be a shocker if you don't make sure that you budget for it. In California, in our natural hazard disclosures, we actually have a form that's a math form that you can calculate the estimated supplemental taxes. So I highly suggest to my buyers that they fill that form out and keep it somewhere so they can kind of remember what they need to budget for that supplemental taxes. All right. Mistake number 10, we'll call it emotional over leveraging. So falling in love with the aesthetic and ignoring the math. So in 2026, buyers are finally back in the driver's seat. You don't have to settle for a fixer-upper at a luxury price, at least in some places. But people still get into bidding wars because they love that pretty kitchen island. Don't do that. I suggest you use the 24-hour rule. Never sign an offer on the same day that you see the house. Go home, look at your spreadsheet, go through your math again, go through your 5-year plan, go through and just take a pause, take a deep breath, make sure you understand what you're getting into, make sure the math works. And yes, you might still love that kitchen island, but make sure that you can afford the kitchen island before you just willy-nilly go and buy it. And then all of a sudden you're having homeowner regret. So make sure you just take a breath, take a pause. All right. So these are the 10 mistakes that I hope you can avoid. 2026, I think, is going to be a good year in real estate if you're smart about it. The lock-in effect is kind of fading. Inventory is growing, and you actually will have the power to negotiate again. So don't waste that power by making these 10 mistakes. So if you found this helpful, grab my 2026 buyer's checklist. I'm going to put it as an attachment or a link in the comments. And I hope you have happy hunting. I hope this is a great year for you if you're in the market to buy a house. And if you're in the market to buy your first house, congratulations. It's a very exciting time. Remember to like, comment, and subscribe. If you've made it to the end of this video, thank you so much. It really helps. I try to just be upfront, honest, no frills. These videos are very no frill. There's not a lot of fancy stuff going on in them. And so as we grow our audience, I find that a lot of people appreciate my kind of just straightforward, no BS approach. Anyway, again, like, comment, and subscribe. I really appreciate it. And share these videos. If you have somebody that's looking to buy, please share these videos. Have them have their agent watch it, or reach out to me and I'll find you an agent. So anyway, thanks everybody. Have a good house hunting trip and make it a great year. All right, talk to y'all later. See y'all later.